top business stories live from the Sky News City studio. UK's third largest supermarket, Asda, reports a slowdown in sales growth but a big rise in underlying profits. Thames Water promises to invest an extra £1.1 billion in its network over the next 5 years. Plus EY on its new spring forecast, which sees economic growth accelerating next year. Good morning, this is Business Live with me, Ian King. Asda this morning reported a slowdown in sales growth, even as it reported a rise in underlying profits. The UK's third largest supermarket said that during the final 3 months of 2023, it grew sales by 2.2% on a like-for-like basis. That's the measure that strips out the impact of store openings and refurbishments. Well, that was slower than the 2.8% at which like-for-like sales grew in the previous quarter and 9.6% in the one before that. While Asda, which is owned by the private equity firm TDR Capital and the brothers Mohsen and Zuba Issa, reported adjusted earnings before interest, taxation and accounting measures to £1.1 billion for the year, which was up 24% on 2022. I've been speaking with Michael Gleeson. He's Asda's Chief Financial Officer.
Clearly, we've been going through a period of significant inflation through the back end of 22 and into the beginning of 23. That inflation definitely began to fall in the second half of 23 and into the beginning of 24. It's still there, though. You know, inflation has come back down, but it's still, I would say, higher than where it was leading into the cost of living crisis. We've tried to do the right things for customers, investing in just essentials, investing in Lidl and Aldi price match. And we are inflating in the first quarter this year slower than the market. But inflation is still there. It's come down, but it's still a bit higher than what it had been.
And what are your expectations for inflation for the rest of this calendar year?
We're expecting, a broad planning assumption is that we expect inflation to continue to ease. It's been a little unpredictable, clearly, over the last 6 to 12 months, but we are expecting some further easing, not in all categories, but we are expecting some easing.
Now, you've reported EBITDA, earnings before interest, taxation, depreciation and amortisation of £1.1 billion for the year.
Yep.
Clive Black, one of the main sector watchers, says it's a bit misleading to talk about EBITDA. It's the sort of thing Ocado does. Can you give me an idea of what's been going on at the pre-tax level?
Yeah, I mean, EBITDA is after rent is how we measure ourselves internally, and it is how we talk to investors. It is the key operating metric for us. I can't speak about other businesses, but that is how we talk to investors, and it is how we manage the business internally. We haven't published PBT today. What we have been saying is that we have returned to growth at the PBT level, but EBITDA is our key performance metric.
You've been losing market share to Tesco and Sainsbury's over the last 12 months or so. To what extent are you being hamstrung by the kind of debt that the group's having to carry?
As we showed this morning, we have reduced leverage. We've reduced leverage from 3.9 times at the beginning of the year down to 3 times. I think what we have done over the last 2.5 years since the change of ownership is we have sought to grow the business. We've invested very materially in establishing a convenience business that we hadn't had before. We've invested about £2.5 billion. In total, we've invested over £3 billion in capital expansion. We've invested in launching a loyalty card. We've invested in Asda Rewards, and it now has 6 million regular customers and accounts for for around 50% of our sales, and all of that within 18 months. We invest in Lidl and Aldi price match. We've become the top traditional supermarket pair as we've invested in colleagues. So, I think we've generally been on a journey of growth, and we're trying to do the right things for our customers, and leverage has reduced. It is on a downward trajectory.
You mentioned convenience there. Do you think you can ever build a convenience business comparable to those of Tesco and Sainsbury's?
Yeah, no, good question. I mean, clearly we have come a little bit later into convenience, and Tesco and JS have developed out a big convenience estate. We have had 2 significant acquisitions in the last 18 months. And we now have, from having no convenience stores midway through last year, beginning of last year, now to having just short of 500. We've also said that we'll open in the medium term 300 organic expresses, and we've got about 100 in the pipeline. So we do see the potential to grow in a big market, and it's an expanding part of the grocery market, and that is where we intend to invest in the coming years.
Now, Asda traditionally has been the most aggressive of the traditional supermarkets in petrol pricing. The Competition and Markets Authority and organisations like the RAC say that's no longer the case. What's informed that change of approach?
Well, as we've been saying, we continue to price competitively in fuel, and certainly in the existing supermarket petrol stations. We continue, as the CMA acknowledged itself, we continue to be the price leader, and when Asda comes into the locality, prices tend to fall. We've now entered a bit more complex market, a more convenience market with the acquisitions, but generally we will be the price leader in the existing supermarkets, something the CMA acknowledged themselves.
Now, Asda hasn't had a permanent chief executive since the change of ownership. When do you expect that to change?
Yeah, as we've been saying, we are actively searching for a CEO, and that process is well underway. And we will look to get the right candidate for that. Headhunters have been retained, and the process is well underway, and we will make an announcement in due course when that search is completed.
Now, it's been reported that Zubair Issa is looking to sell his stake in the business to TDR Capital, which currently owns half of it. What can you say on that?
Look, I'm focused on Asda and getting ahead with trading this important business. What I can say is that the shareholders over time have demonstrated a commitment to growing this business and investing in this business, and their track record has been investors for the long run and staying there for the long run. So, I think the shareholder group has been very committed to Asda.
Thames Water this morning promised to invest an extra £1.1 billion in its network over the next 5 years. Publishing its updated business plan to the industry regulator Ofwat, covering the 5 years to 2030, Thames said this would take its overall investment to £19.8 billion. The company, which supplies 16 million customers in London and the Thames Valley region, said the extra investment would be spent on environmental projects. It stressed that the extra spending would come with no increase to customer bills by any more than the 40% rise it's already proposed for 2025 to 2030, which would take the typical household bill to £608, around £1.67 per day. Some other stories for you now. And the component supplier Tyman has become the latest mid-cap British company to fall to a foreign takeover bid. Tyman, which employs 3,400 people in 16 countries worldwide, has agreed to be bought by the US company Quanex Building Products for £788 million in cash and shares. Tyman, the oldest of whose businesses dates back to 1838, designs and makes components used in sliding sash and bifold doors and smart entry and monitoring products, including sensors and alarms. Mobico, the transport company that used to be called National Express, said this morning that its chief financial officer, James Stamp, would be stepping down in June after accounting issues twice caused it to delay publication of its full-year results. The delays related to working out the future losses the company now expects to make on its German rail operating contracts. The news came as Mobico reported a 36% fall in adjusted full-year pre-tax profits for 2023 to £92.9 million. The shares are currently down 10%. The vape maker Chill Brands said today it has suspended its chief executive, Callum Somerton, after allegations were raised around the use of inside information. The company said the suspension did not constitute disciplinary action or a disciplinary penalty and did not imply any assumption that Mr Somerton is guilty of any misconduct or that any decision has been made. It said it was in the process of appointing an interim chief executive and added that it was engaging with relevant authorities, including the Financial Conduct Authority. The shares have fallen by 17% on that news. And shares of Hornby are off by some 12% today after the Models and Collectibles Group warned that sales in the 3 months to the end of March had come in below expectations. The company, whose brands include Skelectric, Airfix and Corgi, blamed the early timing of Easter and Red Sea delivery days and the resultant movement of some high-value containers into April instead of March. It said that as a result, it expects to report a small widening of pre-tax losses during the year to the end of March. Now, delays to the timing of interest rate cuts from the Bank of England are likely to weigh on the UK economy this year, but should help it accelerate next year. That's according to forecasters the EY Item Club, which this morning published its new spring forecast. It now expects the economy to grow by 0.7% this year, down from the 0.9% it was predicting in January, but it expects the economy to grow by 2% next year, up from its earlier forecast of 1.8%. Well, with me now is Peter Arnold, he's chief economist at EY UK. Peter, good to see you again this morning. How have your assumptions changed on the timing and scale of interest rate cuts?
So I think we saw, when we forecast back in the winter, we were expecting, or perhaps hoping maybe, that the UK economy would avoid that recession at the end of last year. And we now know that, of course, it didn't. So the economy is a little bit weaker than we expected. And that has implications for our headline forecast. And then in respect of interest rates, there's slightly different things, a few things going on there. The markets, if you remember, we saw inflation fall quite rapidly last autumn, and the markets were pricing in some significant interest rate cuts. But the last couple of readings have been perhaps a little bit disappointing. So services inflation remains a little bit higher than we hoped, hasn't fallen as rapidly. And we've also seen wages, the labour market stats last week, wages are still remaining quite high, growing at sort of 6% per annum. So I think that will probably mean that the Bank of England, we would previously expected them to cut in May. We now think they'll probably cut in June, and probably 3 cuts this year rather than the 5 that perhaps we were, again, hoping for and forecasting earlier on in the year in line with market expectations back then. So there's really a change in our sort of interest rate forecast that have conditioned some of the changes to our outlook.
A rate cut in June, you're still being a little more optimistic than a lot of people are.
Yeah, I think that's fair to say, Ian, yes. So, I mean, I think the risk is, in my mind, is the Bank of England looks to what's happened in the US. And in the US, we have seen inflation, having fallen quite rapidly, starting to tick up again. But the US economy is far stronger, I think, than the UK economy. So on balance, I think the Bank of England will cut in June. I think inflation figures, when they come out for April, because we've had big energy price cuts at the beginning of this month, that should show headline inflation close to, if not below, 2%. And we expect inflation to carry on falling over the course of the year and stay below 2% over the course of the summer. So we think there's enough evidence to support that June rate cut. What I think will be interesting to see is what happens in May. The bank will do another reforecasting exercise in May when it meets again. And what they expect to see will probably then condition whether we do get that June cut or whether they sit on their hands and wait till after the summer.
Yeah. What are you expecting to see from business investment specifically this year?
So business investment, we're a little bit more positive around business investment. We think lower inflation should support real wages, lead to better consumer spending, a sort of stronger economy should hopefully encourage business investment. So while we think business investment will grow about 0.6%, actually we expect 2025 to be the stronger year for business investment, so about 3.2% next year. So as a stronger economy, stronger demand side should hopefully lead to a stronger supply side and confidence for businesses to make those investments.
Now, there's a fair bit of uncertainty you point out this morning. I mean, geopolitics most clearly, but you also make the point that the future path of fiscal policy in the UK is uncertain because we've got a general election. But I mean, is that really the case? I mean, whoever wins the next election, there isn't going to be a lot of room for manoeuvre in terms of what they can do. They won't be able to raise public spending very much or necessarily raise taxes that much.
No, I think that's right. I mean, we've seen from what we know there'll be an election in the autumn or perhaps as late as the winter. The polls suggest we'll get a new government, and the Labour Party has been pretty clear that its fiscal policies aren't necessarily that different from the Conservative government. And we know that the fiscal position the country's in is also pretty challenging. You know, the budget deficit's still around 5% of GDP. GDP or debt as a percentage of GDP is still close to 100%. So there are limitations around what any government could do. I think it's more the general political uncertainty ahead of an election. So aligned with fiscal policies, a whole load of supply side reforms you could do, regulation, what might be policy around net zero targets and so on. So I think that you have that general policy uncertainty, even if it's not related to fiscal policy.
Now, Rishi Sunak and Jeremy Hunt are obviously hoping for an uplift in consumer spending this year, following the national insurance cuts and obviously interest rates at some point coming down. What are you expecting to see there?
So again, I think over the course of 2024, we do expect to see a stronger economy, stronger consumer spending, an increase in growth. The national insurance reduction should help. It's quite a significant tax cut that households have benefited from, and that should support consumer spending over the course of the year. So as we head into the autumn, they should be able to expect a stronger economy. I think the key question is whether that helps them politically or not, and they'll obviously be hoping that it will. But you know, that I think will ultimately be a question for the voters and how they feel come the autumn.
The former Treasury Permanent Secretary, Nick Macpherson, has said from an economics point of view, this is quite a good election to win. And you've kind of confirmed that with your growth upgrades today for next year. Yeah, I think there's probably two sides to that. So I think on one hand, as we've discussed, the fiscal situation is quite challenging. So that sort of alleviates or reduces some of the levers you have available. But if you come to power with the economy on the upside and rapid growth ahead, then yes, in theory, the new government will have a little bit of economic momentum and benefit from that feel-good factor that should build through the course of this year and into 2025, and probably claim credit for it. So yes, I think in some respects that might not be a bad time to win an election. All right, Peter, got to leave it there. Good to see you as ever this morning. Thank you very much. Thanks. Still to come here on Business Live, we'll have a look at how the markets are doing this Monday morning. Stay with us. Brilliant, thank you.
It's an opportunity for young people who, just like myself and my co-founder, Phoebe Smith, we didn't have opportunities like this growing up, and we thought that we've had a good run of things. We've been fortunate enough to be able to travel the world, see what's out there, see how we impact the world and how it impacts us. And now we think one of the ways that we can help change the cultures that we're seeing developing, especially in our urban areas, is by inviting more young people into these natural spaces. Well, the great thing about the trip to Antarctica is it does exactly what we hope to achieve, which is introduce young people to places they didn't think that they belonged, or places they didn't think they'd ever get to. And even if they could imagine getting there, they didn't have the resources or the connections to make it. The fallout from Antarctica is that we've had young people who've now changed the courses that they've done that they've gone on to do at university. We've got young people who've managed to get work placements, paid internships as a result of conversations they had on that expedition, and as a result of the learnings, the things they've taken away. I myself, I've had maybe 3 or 4 people, young people, asking for references, and I know Phoebe has too, just and solely because of that trip. I know also that they've used that trip and the experiences that they've had to go on to answer those really difficult questions that you get when you go into an interview, like, tell me a time when you worked as part of a team. Tell me a time when you overcame something that was a cause of anxiety to you. So I know that trips like this one, especially the one to Antarctica, had a huge impact on so many young people. And we keep in touch with them to this day. And I know they go around, they visit schools, talking to other young people and steering them clear of the troubles that's out there on the streets. The last time around, we had about 700 nominations. It was the most difficult thing for me and Phoebe to whittle that down to 10. This time around, we want it to be 10 times as many.
Emirates Premium Economy. Maybe one day all airlines will have seats like this. Fly Emirates, fly better.
Well, Friday's sell-off on Wall Street, which capped the Nasdaq's worst week since 2022, was followed by an overnight mixed session for stocks in the Asia-Pacific region. The highlight in the top left-hand corner there is probably the Nikkei rallying by 1%. You can see the Hong Kong Hang Seng Index rallied by 1.75% as well. In Europe, this is how stocks are trading this morning. Only the MIB in Milan in negative territory just now. Talking points this morning include Embracer, the Swedish gaming group, ahead by some 10% in Stockholm after announcing plans to break itself up. Well, here in London, the FTSE 100 has recaptured the 8,000 mark, currently nearly 1.5% higher right now in a broad-based rally. Sainsbury's and Marks and Spencer are the leading blue chip gainers right now. That's on the back of some supportive broker comment, both of them up by some 3.5%. Jefferies is the broker responsible there. Outside the FTSE, Hypnosis Songs is up by some 10% after the private equity giant Blackstone indicated at the weekend it would pay $1.5 billion for the music investment firm, which last week agreed to a £1.4 billion takeover by Nashville-based Concord. The leading mid-cap gamer, well, I mentioned them earlier on in the programme, Timon. The share's up 31% on that takeover approach. On the foreign exchange markets, well, the pound sold off last week to hit a 5-month low against a basket of currencies, and it has continued where it left off. Sterling currently off by nearly a third of 1% right now against both the dollar and the euro. As for the oil price, well, again, that sold off very sharply last week. It's been a bit driftier again this morning. Currently, a barrel of Brent crude will set you back $86.81 a barrel. That's off just over 0.5% on the session. Well, joining me this morning is Chris Beecham, the Chief Market Analyst at IG. Chris, morning to you. Big sell-off in the pound last week. What's behind all this, do you think?
Comments from the Bank of England really saying that they're still on course to cut rates. Now, this is where the debates come in over the last few weeks. We started the year thinking that everyone will be cutting rates by this point in the year. Of course, that's not the case, certainly for the Fed. The ECB is still edging towards it. And then with the Bank of England, Andrew Bailey had previously said, yes, we're on course, essentially, and then maybe the market started to doubt them. But those comments from Ramsden on Friday really saying, look, things are moving in the right direction. We're happy to give the economy perhaps a bit more space to cut rates. And that's the kind of thing I think consumers do want to hear.
What I find quite surprising, though, Chris, is, I can understand the pound being lower against the dollar. I mean, the Fed is indicating now there may not even be any rate cuts this year. But the Eurozone, the European Central Bank, is expected to go even before the Bank of England. Why is sterling falling against the euro? I mean, it's its lowest level since mid-January. Yeah,
I think it's a question of expectations as well, really. If you look at Eurozone data, it's been awful, I think. And a lot of people actually beginning to say maybe stuff has run its course now for the Eurozone economy. Perhaps things are looking up. And they will be looking at the areas where you've had those bigger losses, maybe the valuations are looking better. So even from an FX perspective, really, people say, yes, the ECB really wants to go hard on rate cuts later in the year, I think. But even so, perhaps the outlook for the Eurozone economy as a result starts to look a little bit better versus the UK.
Now, we're into earnings season in the US in a big way. We hear from 4 of the so-called Magnificent 7 this week. What are you going to be looking out for?
Yeah, not so Magnificent 7 across the board, of course. Tesla, the first one to join the queue, and a really awful year for this one. I think it's a question of looking at how others muscling in on its territory, really. Tesla, the great hope of electric vehicle makers. It's still a dominant position, but as ever, markets are forward-looking. They want to know what comes next. And for Tesla, they're big on the robo-taxi, and they're going to have to deliver on that, really, say, what's the plan for this over the next few months? Better numbers expected, though, from the likes of Microsoft and Alphabet, perhaps. And after this recent sell-off in tech stocks, they're not looking cheap, but they're looking cheaper than they were, perhaps.
Yeah, Microsoft feels like it can do no wrong at the moment.
No, it's delivered the goods in a huge way for investors. Cloud computing, of course, the income from that is incredible. And I think maybe in the short term, there's a bit of worry that they've got a bit more competition from others there, I think. But overall, the dominant position remains the key story here. That's what's so attractive about these big tech stocks for investors. Not that they're so expensive, but they're such strong cash generators.
Well, closer to home, there's a lot of talk about Ocado now, saying, well, maybe it should seek its fortunes in the US.
The latest bit of bad news for the poor old FTSE, really. One of its big stars, of course, one of its few, you could argue it's a tech stock. And that's essentially what Ocado is. And you can understand the rationale to say, look, the supermarket business in the UK is a small part of what you do. The big story is going to be selling this technology around the world, and you get a bigger audience in the US. It's the same story that's seduced so many to go across to New York, I think, and that's really amping up the pressure now on the government, on the stock exchange, to come up with something that can keep these companies, these national champions, if you like, in a way, in the UK.
Someone would say that looking at Ocado's results, I mean, it's the red ink flows fairly freely whenever they publish their results. They're already pretty generously rated by the London market.
They are. They're given a big pass, I think, really. But again, it's the hope that they can really steady the ship. Perhaps, again, they went far too far in terms of the share price in the pandemic immediately afterwards. Last year's been brutal, I think, but maybe people are expecting, well, they're still looking to license this tech around the globe, and that is quite a big money spinner.
Yeah. Now, what about the geopolitics, Chris? I was talking about it briefly with Martin Arnold there. I mean, it feels as though people are taking everything that's going on in the Mideast in their stride just now.
Yes, I think because you've clearly had tensions ramp up over the past 2 or 3 weeks. The Iran attack on Israel, the expected response we saw on Friday, the limited one. With Israel now essentially in Passover for a week, it does mean that geopolitics is kind of on the back burner. Next Monday, things might start to look a little bit different. You've got so much in the way of earnings this week as well. But it's not going away. I think people will be on the watch to see what kind of response you get from Israel. And again, does that provoke another response from Iran? And that's where perhaps the biggest obstacle to any broader recovery in stock markets really lies in the short term.
OK, Chris, got to leave it there. Good to see you as ever. Thanks for joining me today. That's it from me. I'll be back, of course, at 4:30 for our afternoon edition of Business Live. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it will be Jane Secker with more reaction to Rishi Sunak's speech this morning on the controversial Rwanda asylum bill. Stay tuned. I'll see you later on. Thanks for joining me this morning. Cheerio.